Welcome to the WTR Healthcare Happenings podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I'm being joined by Kirk Huntsman, CEO of Vivos Therapeutics, NASDAQ ticker symbol VVOS. Also joining us is my WTR Healthcare Analyst, Robert Sassoon. Vivos is a revenue stage medical technology company focused on developing and commercializing a suite of innovative diagnostic and non-surgical treatment methods for patients suffering from breathing and sleep issues arising from certain dentofacial abnormalities, primarily OSA or obstructive sleep apnea, often referred to as the silent killer, which is estimated to affect as many as 90 million people in the US and 1 billion worldwide. So with that, let me welcome Kirk and Robert to today's podcast. Good morning, gentlemen.
Good morning. Good morning. Thanks for having me.
Good
Kirk,
morning, Tim, and good morning, Kirk.
Kirk, before I hand it over to Robert for some questions, let me start by asking you to give us a quick summary of the key takeaways from Vivos's 2025 results, and how would you assess the progress of your business model pivot relative to your initial expectations at this point?
Yeah, that's a great question. So we went into 2025 really looking to validate a thesis that we had around the best way to commercialize our technology. If you look back at the history of this company, we have this amazing, revolutionary, disruptive technology that addresses a global need, right? 1 billion people on planet Earth have this problem. And it's not just due to being overweight, right? There's children that have this, there's male, female. Sleep apnea is no longer the stereotype of the overweight male, middle-aged, older guy. That is no longer the stereotype. This affects people of all economic strata, all races, all ethnicities, all whatever. And so this is a huge problem. And we have this amazing technology, but it's a technology that is delivered through and by a dentist. And so it sort of got caught, and we got caught in a delivery model that was focused on dentist and through the dental channel, and tried to basically exploit that channel by giving the dentist all the tools that they would need to deliver it. At the end of the day, they said, you know what? We know we have a role to play here, but we don't want to be the guys that are going to lead the charge. So the company was left really sort of looking for a channel that would measure up and be equal to the breakthrough that our technology had been. And so in 2024, we launched with some backing from a private equity sponsor. We actually went and we had this thesis around, if we put our technology in front of patients while they were at the testing center, the sleep testing center on the medical side, then we would hire the dentist to come do their technical part. And the thesis is that would basically change the game. And so going into 2025, it was all about, let's prove that. Let's prove that thesis. And so in 2025, in June, we actually closed on the deal for 7 sleep testing centers in Nevada called Sleep Center of Nevada. Sleep Centers of Nevada became the platform for us and an acquisition to test our thesis. The report that we gave to the world and to the shareholders in our 10K was, the good news is that sort of proving out of our pivot, we call this our strategic pivot, has been a huge success. Now, has it delivered all of the everything that we had hoped for? Have we had no issues? That's not true, right? There were delays in getting in network with the health insurance payers. There were delays, and in the fourth quarter, which I mentioned in my earnings call, we had an unfortunate situation where we lost 3 or 4 of our primary producers, and that caused our revenues to decline unexpectedly in the fourth quarter. What that told us is that we needed to have redundancy in our provider pool. we couldn't just go in and just get by with what it was. And we were also trying to gear up along the way. But at the same time, we knew we needed redundancy. We have solved that redundancy problem. There is no problem with finding dentists. There's no problem with recruiting. There's no problem with staffing this model. The problem is that we got caught in an unfortunate situation. There was a little bit of a black swan type thing where we had these providers had some personal issues, and when we lose a provider, we actually lose. We lose two providers, and that can be $100,000 in a month, right? These guys produce a lot of revenue, each provider, and so it could be $200,000 for each provider that we lose. And so this is a major setback for us. And so while when that happened, we doubled down on our recruitment efforts, we doubled down on our training efforts, and by early January, we had kind of righted the ship on that score. The other issue is that it takes a minute to get these new providers credentialed. And without being fully credentialed, they can't get the full measure of all of the insurance benefits. So that they can do the work, but they can't get all of the in-network payments from insurers. So some of these things are a little bit nuanced and a little bit complex. There's more than one variable at play here. But if you want to know what happened in Q4 and why the trajectory suddenly took a little bit of an unexpected dip, that was it. Fundamentally, there's nothing wrong with the model. Fundamentally, we've rebounded and recovered from that. Everything is moving in the right direction. And we really expect to see late Q1 and in Q2, we're already seeing, we've had record days, record months. I mean, this is all starting to come around exactly where we expected it to be. But we did have that little glitch.
That's actually really, really helpful color. I appreciate that. And with that, I'll turn it over to Robert.
Yeah. Thanks, Tim, and great to see you again, Kirk. And you actually, you actually guessed what I was going to ask you in my first question. So we're going to move on to that because you've answered that pretty well. Other than that, I mean, you are basically using two of the 7 sites, and they were fully booked at the end of 2025 through the month of April. But yet you're capturing less than 40% of inbound patients. So what are the key factors constraining conversion of the remaining 60%, and how quickly can that be remedied?
So that's another great question. And the answer is still going to be the same. The answer is there's two gating factors there that put sort of a chokehold on our ability to process. One is the availability of trained dentists to do the work. That's number one. Number two is the participation of their insurance in this thing. So, I have we have two different sites in Las Vegas. One site, I would say, is lots of volume, lots of patients, and a heavy Medicaid, Medicare population. The other demographic has less Medicaid, less Medicare, and is more a traditional fee-for-service, maybe middle to upper middle class demographic. And so in that practice, we had a lack of capacity in the physical plant, and we have been expanding that. We actually are relocating that entire facility. And what we've done is we've doubled the number of beds, and we've doubled the amount of space so that we'll have the physical plant and capacity to be able to accommodate a higher demographic patient population. We've also gotten, as we announced in the middle of March, we've also gotten in what's called in-network, Robert, with these insurance payers. And that's another game-changing type thing, right? So now instead of trying to just beg these guys to pay us out of network and just to have some of these patients paying more out of pocket, the lower demographic patients have not been able to really afford anything that their insurance wasn't going to pay for. And so we've been wrestling with these two dynamics, and the expansion into Henderson, the expansion of that space, which will be completed next month, and we'll move in by the 1st of June and be fully operational by middle of June, 1st of July. but we've expanded that facility. And then where we have the facility and the flow, we have not had the insurance participation until just recently. Now that we've gotten Medicare and the other commercial payers to put us in network, all of those numbers are ticking north. So it's been those same two things. And now we have plenty of service days and service providers. So we have plenty of dentists recruited, onboarded, trained, and starting their position. And they're more full-time types as opposed to, basically a montage of sort of piecemeal. I'll give you 2 days a week or here, or I'll give you 2 days a week there. These are full-time trained clinical doctors that'll be there. All that makes a huge difference.
Right. So with the physical infrastructure that you're getting, you say you're going to be moving into by maybe the beginning of the third quarter. That's when you'll probably see a ramp up.
Yeah, I think we're going to see a ramp in Q2, and I think we're going to see a ramp in Q3. I think you're going to see this thing really hit. We're already seeing it. I mean, this is not something that we have to speculate about. I think it's happening. So
that's great. So regarding the in-network payer credentialing you secured in the end of the first quarter, can you actually quantify for us the covered lives this represents in Nevada and outline maybe the expected timeline and magnitude of impact on inbound patient volumes and revenue from that particular event?
Well, Robert, I haven't done personally that analysis. I can tell you that what I've seen that others have done is that we're now basically we have covered lives about half of the population of the greater Nevada or greater Las Vegas market. I'm not sure that statistic though really gets to the core of it, because what really happens there is that there are 37 hospitals in the Las Vegas market, and every one of those hospitals refers to Sleep Center Nevada and has for many years. There are also independent groups, large cardiology groups, large primary care physician groups that refer almost exclusively to health or to Sleep Center Nevada. And so while we have the coverage, and that's great, and it's a significant amount of people that are covered, we've treated at Sleep Center Nevada, and I say we because we own it now, but since 2019, so just in the last 6 years, we've actually treated over 10% of the population of Las Vegas. They've actually come in for sleep tests. So it speaks to, I think, sort of the reputation of this sleep center group that we acquired. It speaks to the pervasiveness of this condition. Remember, 80% of patients that have this condition are undiagnosed and untreated. So we've got plenty of patients at the top of the funnel. The problem is, or has been, how do we get them processed through the funnel? How do we have enough doctors? How do we have enough physical plant facilities? How do we have enough of open appointments to process everybody through? And all of those things are being, in fact, I'm here today in Colorado with my ops team. We're having an all-day session on expanding the teams and expanding the appointment schedules and working towards facilitating even more. Because if we can turn the spigot on even further, that just opens up more and more and more opportunities. But we have plenty of people at the top of the funnel.
Great. So you're targeting cash flow positivity by the end of 2026. And I think was indicated that to get to that point, you need to double or virtually double your 2025 revenue. So that run rate would be double the $17.4 million that you reported for 2025. So can you walk us through the key levers and assumptions that need to come together to achieve that outcome?
Yeah, that's another great question. And so here's the metric and the dynamic that we are experiencing. And this is what happened. And I think I alluded to this it may have been the Q&A part of the earnings call, but I want to really hone in on this because it's a really important thing to understand. When word got out to the medical community of what we had done out there in Nevada, word spread fast, and it spread fast throughout the entire United States, throughout the entire sleep medicine community, because nobody had ever done something like that before. There had never been a public company that had gone out and had acquired a large sleep group like what we did. And so, there was a buzz. And what happened is that buzz translated down into some of the other providers that have a real interest and a stake in what happens in the sleep medicine world. And so we started getting phone calls from hospitals, chief cardiologists in medical centers, large cardiology groups, and even local there in Las Vegas. One of the largest cardiology groups in the country is actually there in Las Vegas. It's Sleep Center or Nevada Heart and Vascular. These guys see tens of thousands of patients every month. We had a call from a group in Arizona. We had a call from a group in Florida. We had calls all around the country. And what their basic pitch to us was, what their basic thing is, hey, what are you guys doing? Because as cardiologists, and this is just one example, as cardiologists, we see tens of thousands of patients every month, and almost all of them have sleep apnea. In the one group from Arizona, they said to us, you know how we know that? Because we've been testing them for the last 2 years. And we now know that obstructive sleep apnea is cardiovascular disease, the number one killer of mankind, that there's an element that for many patients that come to us with cardiovascular disease, if they have sleep apnea, their sleep apnea is wrecking all the interventions that we're trying to do as cardiologists. And if we put a stent in, instead of lasting 7 years, it lasts 4 years. And so our patients are having more and more frequent hospital admissions, more frequent events, cardiovascular events. And so we're trying to find somebody who can test these patients for sleep apnea and monitor them, treat them. And the fact that you guys have a novel technology is just a big bonus. And so what's happened to be a proof of concept, a platform, if you will, right? And so now that we've proven that we can bring a value-added service to the table, now we go to these other cardiology groups and they're like, we're ready to refer to you today. So we're in the process of getting leases and getting people hired and getting doctors on board in various markets right now today so that we can handle the thousands of patients. So if you want to know how we're planning to ramp that up, I only need 2 or 3 of these between now and the end of the year to be able to hit that cash flow break-even number, because the patients are there. We've solved the insurance problem, so now we know how to get the insurance in. Instead of waiting 9 months, we can get on the insurance programs within 60 days. We now know from the time we open our doors. So now we've got everything compressed, and now we've got the ability to go just knock these things out. I was with a group last week in South Florida, and right there they said to us, they had no idea who we were. We took them to dinner. This was the 2 leading cardiologists and their CEO, very large group. And they said, where have you guys been? We have 30 some odd thousand patients that need what you have to offer, and we can't get sleep doctors to do anything about it. And so we have a solution that these guys are looking for. So we're actively engaged there, and that's how we plan to hit these numbers and exceed expectations.
Right. So you really have addressed pretty well the revenue side, but on the cost side, you mentioned at the end of last month, I think you announced a 4 million annualized cost reduction initiative. So where are those sort of savings going to come from, and how should investors think about the cadence of the planned cost reductions in the coming quarters?
Well, I think from the inside of this company, as we saw the model take hold out there in Nevada, we realized that we no longer needed to support our legacy model that we had, with the dental community. We felt like we needed to kind of keep some overhead to just, support these dentists as they continue to do their thing. But the real future, once we realized that the future was really what we thought it was going to be over here in the medical side with the sleep centers and the cardiologists, et cetera, then we lopped off the overhead that we were carrying to support this other side. And look, I mean, there were some dentists that were, not thrilled about that, but because they had been used to a certain level of service from us, but we maintained a skeleton crew there, but we lopped off a lot of that overhead, and we focused in our resources on the development and growth in this model that we now have that we're saying is so successful.
Right. So you were talking about the previous question about the focus on affiliates. What actually brought about that strategic refinement? As you mean, I mean, moving away from sort of the acquisition heavy growth toward a more capital efficient affiliate expansion strategy.
Well, again, I think in the search for a model to commercialize and monetize this technology, we first explored, if you go back a couple of years, we explored a relationship with a group here in Colorado, and we didn't have enough control over the entire process. And because we didn't have that control, the thing just didn't work. And so we sort of pivoted and we said, you know what, for us to be successful, we need to have that. We need to have total control there. The situation in Nevada is one where we have total control. We own the entire thing, soup to nuts. Now we figured out, if we partner the right way with a group like a cardiology group, a neurology group, a primary care physician group, or any number of other specialty groups, if we partner the right way, we can affect the kind of control we need and also facilitate the kind of incentives and the kind of whatever to have a collaborative effort to make sure that patients get the kind of care that they need. And so we've kind of swung the pendulum from one side to the other side, and now we're looking at this thing and we're working towards a capital efficient model. So we don't have to go raise $500 million to go buy up all the sleep centers that are available to us. When we go to these guys, the sleep centers and the cardiologists have all the same problem. They know that sleep apnea is a problem. They know that most of their patients are testing positive for sleep apnea. And they know that none of their patients want a CPAP, and they're looking for alternatives, which is exactly what we bring to the table. And so we are evolving our model to be capital efficient. We're evolving our model to be operationally efficient. And as we go down the road, we think we're just getting better and better and better at executing on this, and that's the evolution of the model.
Right. So Vivos has one affiliate up and running at the moment in Detroit, in the Detroit area. How is that site performing, and how many you actually addressed this at least partially? How many additional affiliates are you targeting to close this year, and how quickly can new affiliates be operationalized relative to the break-even timeline, that at least the cash flow break-even timeline that you've set yourselves?
So we are expanding and growing our Detroit operation, and I would say so far it's been not everything that we had hoped it would be. We just remember we put that together before we had our control issues figured out in our documentation and the way that we wanted to set these up. So we've encountered a few headwinds there that we kind of are working through, but I think the potential for that is still very high. I think we're very hopeful that that's going to still turn around. But we have, in the new models that we're talking about, we have a lockdown, more controllable, more scalable, more replicable set of agreements than what we've ever had before. So while I'm not personally happy with the results. I think it's fairly pedestrian out of Detroit so far. I think there's still the prospect of making making that to be a good project. But the ones that we have that are where we're going in with these cardiology groups and the bigger groups that are actually under our new model, I think that's the way that we're going to be seeing the things
Right.
roll.
Okay. So Vivos exited 2025 with an 8.4 million of largely SCN related debt. That's maturing this year actually, and about 2 million in dollars in cash. Now, does the End-2026 cash flow target assume any additional financing beyond the 6.9 million of equity raises that occurred in the first quarter, and already that you've completed by the end of the first quarter. So, are we sort of expecting more financing?
Yes, and we will need more financing, and we're working on some non-dilutive financing that will be related to our intellectual property. We're working on some equity raises. We're working on a rights offering. We've got several different things in the hopper here. Look, our objective is to outperform the dilutive effects of additional capital. One of the things I will say is that the additional capital that we will raise from this point forward, whether it's debt or equity, will go directly into the highly accretive, highly profitable models that we're talking about here. We will be expanding our footprint and our relationships in Las Vegas. We'll be expanding into Arizona. We'll be expanding to some of these other places where we are developing these contractual relationships. Look, the plan is the only way that you fix this type of dilution is by outperforming the dilutive effects of that additional capital. And so we realize that that's the place that we're in. Look, we've obviously anybody who looks closely at our cap table, our balance sheet, whatever, is going to realize that this company has had to do what it had to do to survive. And we have an overhang with some warrants. We have an overhang with we have some equity that is out there, but we've not done anything that has been so toxic that it is causing us to be a problem. The debt will go away over time. Either it'll convert into equity or it'll go away as we pay it down. And our biggest objective right now, our biggest exit out of this is to outperform, and that's exactly what we intend to do.
So Seneca Partners is now your largest external shareholder, just under 20% of equity, and has been the primary capital source through this business model transition. Has that relationship evolved beyond financing into an advisory or strategic role? And has Seneca indicated whether it would continue supporting you if the path to year-end cash flow positivity takes longer than planned?
I've run a number of equity or private equity-backed companies in my career. I've worked with all kinds of different private equity groups. I've got to tell you, the folks at New Seneca Partners have been among the very best partners that I've ever had. They have been amazing to work with. They are 1,000% bought in. They keep supporting us. They are behind us, and I was with them all last week. We were together down in Florida. We're working on a number of different additional rounds of financing, as I mentioned. And so what I would say to that is they're seeing everything that I'm talking about, and they're putting their money behind it, right? So from the inside, really between the sheets type look at things, these guys are all in. They're not throwing good money after bad. They really see the upside potential here, and they're following. They're putting their money where their mouth is here on this.
Right. So the final question for me. So outside of Seneca partners, what do you believe investors are still underappreciating most about Vivos's story today?
Well, I don't think they appreciate the upside. I think that's really what it is. I mean, look, there's an argument that could be made that Vivos needs to prove that that it can execute, right? There's a case that an outside investor looking at us would say, hey, these guys need to show us that they can actually string together some profitable quarters and that this model is truly doing everything that Kirk's talking about and blah, blah, blah. I get that. But what I don't think is being factored into this equation is the first of all, the reality of how well this is working in Nevada and what that means in terms of, sort of you sort of extrapolate that out as you scale this up. What does that mean? That means this company is headed into a, several $100 million annual revenue and highly profitable. We're talking about 60% contribution margins out of these operations out there. I mean, you don't have very many businesses that can throw that off. So I think that's what's not being factored in, and there's probably some skepticism. I know there's been a lot of people short in the stock, and that probably there's some headwinds because of that, but I actually think that the actual what's being missed by the market right now is that this company has solved its commercialization problem. We figured out the game, and now we're playing the game to win, and we're not going to stop. We've been through a lot worse than this, and we're not going to stop. And we're going to come out as the leading technology in a huge global space.
Yeah, it seems you've got the technology, the demand is obviously there, and it's all about execution.
Yeah.
So thank you, Kirk, for those very thoughtful answers. And I'm going to hand it back to Tim.
Yeah, I would just chime in, Robert, on what you said and agree or mirror your comments. It's a massive total addressable market from my understanding. And I will say, as kind of just a passerby observation, I'm seeing OSA mentioned in business journals and other periodicals on a increased frequency basis. So the awareness is there as well. So it seems like you're at the right place at the right time. So thanks for your time today, Kirk.
Yeah. Thank you, guys. Appreciate it.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Healthcare Happenings podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.